Welcome back to our final Chapter 5 video. We'll talk about notes receivable and some other kinds of ways of dealing with your receivables. Well, first, let's just talk about cash management. If you remember in Chapter 4, we said we need to have good controls on our cash. We need to make sure that we are dividing the responsibilities for cash, and we need to pay attention to the cash flow in our company. Now, when we're talking about the receivable side, which is the cash inflows to the company, we want to speed them up as much as possible, which is why earlier in the chapter we discussed the idea of a sales discount, which is a reduction in the total revenue in order to encourage our customers to pay early. Now, there's something else that sometimes companies do to speed up the receipt of their receivables. What they do is they factor them. Now, this is a particular term we use mostly only in finance and business and accounting. When we factor our receivables, what we're doing is selling them. So what we get is a lump sum right up front of all of our receivables, usually at a discount. We don't get the full dollar amount. Some other company then will deal with the collections. They also can deal with the bad debts. And if you've seen any Hollywood movies about people who have to repossess the property of those who are not paying for that property, then you know that it's difficult to collect on bad debts. So sometimes companies don't want to deal with collecting their old receivables, and so they'll sell them off to another company to do the collecting. Again, as we said, you don't always usually get the 100% of whatever you're owed. You get some sort of discount. But it is a way for a company to get more cash a lot more quickly. Another thing companies do is they encourage the use of credit cards by their customers. This is actually another way for businesses to factor or sell their receivables. It means they don't require cash up front from their customers. What they do is they allow their customers to pay with the credit card, meaning the bank then pays the seller, usually within 24 to 48 hours, but they don't give the seller the full amount of the sale. There's always some sort of discount, often called the merchant fee. So it speeds cash collection and it reduces the bad debts, but it does mean that the company receives a little less than the total sale. One other way to deal with receivables is to help out some of your customers. Sometimes, and you will know this from car sales, sometimes customers cannot pay cash up front, nor can they pay cash within 10 to 60 days. They actually need a loan in order to purchase. And this happens with car sellers a lot. Most individuals are not able to pay cash for a new car up front, and so companies like Ford and GM and BMW will offer loans. Now, for a business that's going to offer the loans that are 12 months or less, we call it, as we mentioned earlier, a notes receivable. It's going to specify an interest rate, and it's going to specify a maturity date. The principal is the amount of the loan itself, the amount of the note. Remember, notes are technically loans, but the amount of the note is the principal. P-A-L, not P-L-E. And interest is additional money owed, and it will always be some percent of principal. It will be quoted as an annual rate. But notes receivable often are for periods of maturity shorter than 1 year. So in order to figure out how much interest is owed on a notes receivable, you take the principal amount, you multiply it by the annual interest rate, and then you also multiply it by whatever fraction of a year the maturity is. And remember, if a note receivable, if the maturity of it will extend across 2 accounting periods, you must accrue interest income for the company that's issuing the notes receivable, for the company that is waiting to receive principal and interest. So let's deal with an example. Cornerstone 5.4 in your book talks about Dover Electric Company. They purchased on account $50,000 of consulting services from Thomas Limited. They did this on November 1st. The amount was due in full 2 months later, 60 days, on January 1st, 2012. Unfortunately, Dover Electric was unable to pay that amount on the due date, so they negotiate an extension. with a 10%, 10% meaning the interest rate, in lieu of the unpaid account receivable. So they've got a note now instead of an account receivable. What we're going to do is we're going to look at the effect on this particular transaction on the seller. The seller is Thomas Limited. So first, let's just look at what the journal entries would be to first record the sale on November 1st and then the modification of payment terms on January 1st, 2012. What did it look like on November 1st? Before Thomas thought that there was going to be any problem with Dover paying, they sold them $50,000 of consulting services. That meant they had a revenue of $50,000 and an accounts receivable of $50,000, right? Accounts receivable would have been a debit entry because it's an asset account, and their revenue would have been a credit entry of $50,000. And Thomas Limited would have expected to get paid in full on January 1st, 2012. But then January 1st, 2012 rolls around. And what happens? Dover comes calling and says, uh-oh, we can't pay. Can we renegotiate? Thomas says yes. They renegotiate a notes payable in the exact same amount of the invoice, and it is due at some point in the future, which means we need to clear that accounts receivable. We no longer want to have an accounts receivable of $50,000 because accounts receivable says it's usually due within 60 days. Well, Dover Electric was not able to pay within 60 days, so we need to clear the accounts receivable account by entering a credit of $50,000. And now we're going to add the notes receivable, which is an asset account, and so we're going to have a debit of $50,000. We've now issued a note receivable. For notes and for bonds, we use this term issued. It means Thomas is allowing for this loan. They are extending the loan. So now, we need to figure out how much interest Thomas is going to receive. Dover is going to have to pay. Let's look at 3 different time periods over which this note could be extended. Remember that interest equals the principal amount times the annual interest rate times whatever fraction of a year the note maturity is. So let's look first at July 1st, 2012. If the note is issued, it begins on January 1st. And if it was paid back on July 1st, how many months would it have been outstanding? 6 months. So if it was paid back on July 1st, 2012, the interest would have been principal amount of $50,000 times a 10% interest rate. Remember, 10% is written as 0.10 times 6 divided by 12. That's 6 months it was outstanding out of 12 months in the year. That means it would have been $2,500 of interest. Now, do it yourself. How long would the note have been outstanding if it was repaid on December 31st, 2012? Right, that would have been 12 months. Meaning, if the note was repaid on December 31st, 2012, the interest would have been the principal of $50,000 times an annual interest rate of 0.10 or 10% times 12 months outstanding out of 12 months of the year, which is just like saying times 1. Which means if it was repaid on December 31st, 2012, it would have been $5,000 of interest. Now, what if it was repaid on March 31st, 2013? How many months would that have been outstanding if it was issued on January 1st, 2012? Well, there would have been the full 12 months of 2012 plus January, February, and March of 2013. So that would have been 15 months outstanding out of 12 months in the year. So that would have been $6,250 of interest. Okay, let's pick one of those situations. Let's presume that the note will be repaid during the longest maturity, which was March 31st, 2013. At the end of 2012, there would have been a note outstanding that was going over or crossing multiple accounting periods. We've got to make an adjusting entry for the interest income, right? Thomas is owed interest throughout all of 2012, but it won't get paid until March 31st, 2013. So when they're closing the books at the end of December 2012, they've got to make an adjusting entry. How do you make an adjusting entry for interest income? Interest that you expect to receive? Well, you're going to have an interest receivable. And remember, if it was going to be repaid on March 31st, we expected to at least accrue a full year's of interest as of December 31st, 2012. That's $5,000 worth of interest. They'll get more for 2013, but right now we're just dealing with what interest they're going to be owed for the 2012 period. $5,000 of interest is a debit to interest receivable, and since that can also be recorded as interest income, it's a revenue account, so we've got a credit of $5,000 also. This is the adjusting entry if the note receivable was not repaid until sometime in 2013. We would have to make an adjustment at the end of 2012. Now, your book asks you, let's go back to those 3 different repayment dates. Let's assume, first of all, the note is repaid with interest on July 1st, 2012, or December 31st, 2012, or lastly, March 31st, that should be 2013, little typo right there. How would we record those journal entries? Well, let's think about what needs to be recorded. If the note were repaid on July 1st, 2012, what would be our debit entry? And we definitely have some cash, right? Now, how much cash would Thomas receive from Dover on July 1st, 2012 if it was paid principal plus interest? Well, we know it's got to be principal of $50,000 plus how much was the interest if it was repaid on July 1st? Right, $2,500. So it would actually be a debit of $52,500 to cash. Now, what are our credit entries? Well, I'm going to clear my notes receivable account. So that was the total note receivable was the principal of $50,000. That's notes receivable. That account should only be dealing with the principal. And then I've got interest income of $2,500. And the two together add up to the cash received of $52,500. Now you think about December 31st, 2012. What would the entry look like? Right. There's going to be another cash entry. Got a debit, which is going to be at least the amount of the principal of $50,000 plus whatever interest was owed. Well, it would have been 12 months of interest, and we had determined that was $5,000. So $50,000 plus $5,000 is going to be $55,000. We still have the note receivable that is now being repaid, so we have to credit the receivable account for the principal amount. And then I've got an interest income account, which is a revenue account. So I'm going to credit it for $5,000. $50,000 plus $5,000 equals my $55,000 in cash. What if the note was repaid with principal and interest on March 31st, 2013? What would be my entry on March 31st, 2013? Okay, you're getting the hang of this, so you know we need to start with a debit to cash. How much would it be? Well, we had determined that there would be $6,250 of total interest if it's repaid on March 31st, 2013. If we add that to the principal amount, then we know that $56,250 is going to be debited to cash because Thomas will receive that much in cash from Dover Electric. Now, how do we break down that $56,250? Once again, you know that the only way to account for, having a little trouble with our pen here, it's just erasing itself. We're going to have a debit to note receivable, always of the principal amount, $50,000. We never change the principal amount, which means when we go to clear notes receivable, it's always a credit for the principal of $50,000. Now we know that there's $6,250 total of interest. But do we credit all of that to interest income? Is all of that 2013 income? No, it's not. If you recall, we already dealt with $5,000 worth of that income when we had to accrue the interest at the end of 2012. When we accrued the interest, we discovered that there was an interest receivable amount. Having lots of trouble over here with our pen, so we'll just not worry about that. There was an interest receivable of $5,000. Now we can clear that receivable. And we only have the 2013 interest income of $1,250. That's the only bit for 3 months worth, January, February, and March of 2013. That's the only bit that is current income. It's all nice and neat right here. Note, again, if it is repaid 15 months later on March 13th, we get a total of $56,250. Of that, principal repayment is $50,000, which is a credit to notes receivable. Interest receivable, which had been accrued at the end of 2012, is now cleared to the tune of $5,000. And there is an additional $1,250 worth of interest income that occurred in 2013. Now, just to round out the chapter, we do want to just quickly remind ourselves that credit sales are kind of part of the territory for business these days. Now, obviously, we've talked about bad debt. We've talked about the fact that sometimes we have to renegotiate with our customers and even issue them a long-term note or at least a several-month note. Why do we keep doing it? Well, in large part, customers expect it. We might lose customers if we don't do it, and we might lower our overall sales. To try to control for the risk of bad debt, we want to have internal control ideas. So if you are a company that generally sells to other businesses, you're going to issue purchase orders. It's going to be a specific document that labels exactly how much of each unit is being purchased, exactly what the price is being agreed to, exactly what the payment terms will be, so that is all done before the order is filled. There are also going to be shipping and billing documents to make sure that they exactly match the purchase order, or if there are any changes from the purchase order, exactly what that is. So we usually issue invoices, which is the billing document, and then we usually have a shipping manifest or some sort of shipping document that also goes along with it. And then we're careful to book our sales and receivables only when a purchase order, a shipping document, and an invoice has been issued. We try not to be sloppy about it when we're dealing with large orders. This is the conclusion of Chapter 5.